big credit changes are coming in 2025, and they can drop your score without warning, meaning that you could get denied for a mortgage, car loan, or a credit card even if you thought your credit was solid. But here's the good news. If you understand these changes now, you can actually use them to your advantage and protect your financial future. No one is talking about these FICO updates, bank mergers, and policy shifts the way that I'm about to, so let's get into it. As of January 7th, 2025, a new rule bans medical debt from credit reports. This means lenders can no longer see unpaid medical collections when making lending decisions. The rule also prevents lenders from using medical devices as collateral for loans, further protecting consumers. 1 in 3 Americans has medical debt, and this change is expected to increase credit scores by an average of 20 points, lead to 22,000 additional mortgage approvals every year, and make it easier to get credit cards and auto loans. While this rule isn't final yet, it takes 60 days for it to become law, which it won't be official until early of April. And here's where things get complicated, because the agency behind this rule might not exist for much longer. At the making of this video, currently the Trump administration is actively working to shut down the CFPB, the agency that's responsible for enforcing consumer protections. This agency is the reason behind the new medical debt rule, and without it, this rule could disappear. New leadership has already begun mass layoffs, firing over 1,700 employees. Elon Musk's Department of Government Efficiency, also known as DOGE, is overseeing the shutdown process. The past few weeks, the CFPB has dropped multiple lawsuits against financial institutions, including a $2 billion lawsuit against Capital One for misleading customers about interest rates, a case against Rocket Homes for deceptive mortgage practices, and lawsuits against student loan servicers and predatory lenders. If the CFPB actually shuts down, it means fewer protections from banking fraud to hidden fees and credit reporting errors. Right now, the courts are blocking some of the shutdown efforts, but the future of the CFPB and this medical debt rule is still up in the air. If the agency shuts down, then this debt rule might change. Old medical collections could then reappear on credit reports, which would mean credit scores dropping for millions of people, harder loan approvals for homes, cars, and credit cards, and higher borrowing costs across the board. For now, the medical debt rule is in place, but depending on legal rulings and leadership changes, it could be wiped out overnight. Something to note here is that some scoring models already have less of an emphasis on medical collections, and collections under $500 should not be reported. So if the CFPB shuts down, here's what happened next. There's going to be more hidden banking fees since the CFPB was cracking down on overdraft and junk fees. There's going to be weaker protections against fraud, making it harder to dispute wrongful charges or incorrect mortgage calculations. There's also going to be less oversight on credit reporting, meaning that credit bureaus like Experian and Equifax may not be held accountable for errors. With fewer regulations, banks and lenders will have more freedom to charge higher fees and make changes without consumer protections. So with so much uncertainty, here's how you can protect yourself right now. First is to check your credit report regularly to ensure medical debt does not reappear. Next is to watch for increased banking fees on accounts and loans, and also dispute any credit reporting errors immediately while the CFPB is still here. And if you need help fixing your credit, I do have a software called Credit Rehab Pro that makes the process simple. It's designed to help you remove negative items like collections, charge-offs, and late payments so you can qualify for better rates and get you approved for credit cards. Just look at Malcolm. He successfully removed 3 charge-offs from his credit report. Or Michael, who got 3 collections deleted. And then there's Andrew. He removed 3 collections in his first round of letters. If you want to see results like this, click the link down in the description or scan the QR code right here. But here's the thing, fixing your credit, it's only half the battle. Even if you remove negative items, your score could still change depending on the credit scoring model that lender uses. Credit scoring is changing, and if you're not paying close attention, you can see a sudden drop in your score. That's because lenders are moving away from older models and switching to FICO 10T and VantageScore 4.0 more in 2025. These models aren't new, but now that more lenders are using them, your credit score could be calculated very differently. The first one to worry about is FICO 10T. Unlike older scoring models that take a quick snapshot of your credit, FICO 10T tracks your credit behavior over the past 24 months. This means carrying high credit card balances for months will hurt your score more than before. Next is paying off large balances all at once won't give you an instant score boost. And third, slowly reducing debt over time is the best way to improve the score. Lenders using FICO 10T care more about your long-term trends and not what your balance looks like today. And that's not all. FICO 10T is also making it harder to boost your score using trade lines. For years, people have been using authorized user accounts to get quick credit score increases, but under FICO 10T, the strategy won't be as effective. With this score, trade lines will carry less weight, meaning smaller score increases. Lenders will also focus more on individual credit history and not shared accounts. This shift is designed to stop artificial score inflation and push borrowers to build their own credit history. So if you relied on authorized user accounts to boost your score, then you're gonna need a new strategy. Now for Vantage 4.0, this one is different. It focuses more on alternative data, making it easier for people with thin credit profiles to build a score. This model includes rental payments and utility bills, helping renters build credit with on-time payments. They also include buy now, pay later loans. These were invisible before, but now they affect your score. It also has a more lenient approach against medical debt, so past medical bills won't hurt as much. If you don't use credit cards or loans often, VantageScore 4.0 could actually work in your favor. So what does this all mean for your credit score? So one is carrying credit card balances for months will hurt more under FICO 10T. Renters and buy now, pay later users could see a credit boost with Vantage 4.0. And third, most mortgage lenders still use older FICO scoring models, so the majority of home buyers won't be affected quite yet. But if you are in a market to buy a home, double check with your lender to see which credit scoring model that they use. So to stay ahead of these changes, you want to avoid carrying high balances for a long period of time. Paying down credit steadily over time will be rewarded under FICO 10T. Utilization used to have no memory, but under this model, it will. Next is to make sure rent and utility payments are reported. VantageScore 4.0 counts them, which can improve credit scores. There are plenty of services that offer this, such as Rent Reporters or BoomPay. And third, if you have a thin or starting to build credit, open up a secure credit card or credit builder loan, since these are stronger alternatives to authorized user accounts. And fourth, if you're using buy now, pay later, make on-time payments because these accounts are starting to appear on credit reports and affect scores. For years, buy now, pay later loans like Affirm, Klarna, or Afterpay were invisible to lenders. That's all changing in 2025. Buy now, pay later loans have started to be reported to the credit bureaus, which means that they can either boost your score or drag it down. In recent years, these have exploded in popularity. They let you split purchases into smaller payments without using your credit card, making it a go-to option for millions of people. So with these loans showing up in your credit report, this means that on-time payments can help you build credit, especially for people with little credit history. On the flip side, missed payments will now lower your score, just like credit cards or personal loans. And lastly, this type of debt will count towards your total debt load, which could make it harder to qualify for mortgages, auto loans, or credit cards. Equifax, Experian, and TransUnion have confirmed that most BNPL lenders will now report to these accounts. If you frequently use buy now, pay later, expect to see it on your credit report. Keep in mind that this will be for new loans rather than backdating old loans. Several major buy now, pay later providers have already started reporting accounts, including Affirm, which reports both on-time and missed payments to Experian, Apple Pay Later, which reports payment history to Experian but does not affect your credit scores yet, Klarna, which report missed payments to the credit bureaus, and Zip and Afterpay, which is expected to start reporting in late of 2025. Now, some of these providers only report late payments, while others report both positive and negative payment history. So this means that you can either be building credit or damaging it without realizing it. The thing about these loans is that it seems like an easy way to pay over time, but they come with hidden risks. Multiple BNPL loans could hurt your credit. Taking out several of these loans in a short period of time can be seen as risky. Since these products are loans, even though most don't charge interest, they will still count as active debt on your credit report. Another potential risk with these loans is that returning items can be complicated because refunds always can't cancel payments immediately, meaning that you might still have to make payments even if you send the item back. A 2024 study found that buy now, pay later loans users spend 48% more than those using other payment methods, leading to higher debt levels overall. If you want to avoid credit score damage, here's what to do. First is to limit these products before big purchases. Too many of these accounts can hurt your approval chances for car loans or mortgages. Second is to make sure you make all the payments on time because late payments are now being reported and they can drop your score fast. And third, before you decide to take out one of these loans, double check to see if it reports to the credit bureaus, because some still don't, meaning that you can actually use it strategically to avoid score impacts. Next is that in 2025, checking your credit is about to get more expensive. FICO and credit bureaus are raising their prices and lenders are passing those costs to borrowers. FICO has increased the price of its credit score reports by 20%. Mortgage lenders are now paying up to $8.75 per joint credit report, up from around $5. This means that you can see higher fees when applying for mortgages, car loans, and even some credit cards. As credit reports are becoming more expensive, banks are most likely going to be cutting costs by changing how they do credit pulls. Traditionally, mortgage lenders use a tri-merge credit report, which combines scores from Experian, Equifax, and TransUnion. But now some lenders are thinking about dropping one credit bureau entirely. So if you are applying for a loan, ask which credit bureaus that your lender checks and make sure that the reports are accurate. Now moving on to one of the biggest banking shakeups of 2025 is Capital One acquiring Discover for a $35.3 billion deal. If approved, this will make Capital One one of the largest credit card issuers in the US. But this deal does face serious challenges. Regulators are reviewing the merger over concerns that it could reduce competition and raise costs for consumers. The DOJ, FTC, and Federal Reserve are scrutinizing the deal, with the decision expected to take up to 18 months. 3 lawsuits have been filed alleging lack of transparency and potential harm to borrowers. Despite this, 99% of Capital One and Discover shareholders approved the deal in February of 2025. The deadline is finalized as it's been pushed to May 19th of 2025. If this deal does go through, for Discovered cardholders, your card might be rebranded under Capital One. Your rewards program and interest rates could also change, and some Discover cards may be discontinued. On the other hand, for Capital One customers, new card options may become available, interest rates and credit limits could change based on Discover's policies. Third is potential higher fees due to reduced competition. Now, all of these changes are coming fast, and if you don't prepare now, you could face higher fees, lower credit limits, and even loan denials. But knowing what's changing isn't enough. You need a strategy to stay ahead of these new credit rules. If you want to stay ahead of the curve with the latest credit tips and hacks, I have a community that can provide more hands-on help. Click the link down below or scan the QR code to learn more about the Credit Collective.